Okay, so we're starting chapter 5. And it's a little bit different than what we've been doing for the last 4 weeks. So it's called cost, volume, profit, like relationship. So we're going to look at the analysis of the cost and the profit, trying to figure out your break-even point. If you make changes through your variable expenses or your fixed expenses, how does that affect your profit? So we're going to walk through, it's going to be like one example, and we're going to change things as we go to look at the difference, to see how making changes to one thing, you lower the price of the sale price. How does that change everything if you increase your quantity? If you have to increase your fixed expenses, how does that change things? So we're going to look at the cost, we're going to look at the volume, which is the quantity, and the profit, which is the money that you're making, and the relationship between those things. Okay, so let's just read this a little bit because it's like kind of an overview. So to simplify cost, volume, profit analysis, so the calculations, managers typically adopt the following assumptions with respect to these factors. So selling price is constant. Price of a product or service will not change as volume changes. So there'll be some examples we'll go through that we won't change the sale price. And then we have cost are linear and can be accurately divided into variable and fixed components. So we'll know what our fixed costs are and what our variable costs are going to be. Variable costs are constant per unit, and the fixed costs are constant in their total over the relevant range. So we talked about the fixed cost. So the fixed cost is what it is. It's going to stay the same no matter if you produce in 500 units or you produce in 1,000 units. That cost is going to stay the same. So as you increase production within that relevant range, the price per unit will decrease. The variable cost not changing means that it doesn't matter how many you produce, that number stays the same. It's going to fluctuate by quantity. So remember, we take the amount and times it by the quantity to come up with a total. And so if we just change the units, the price is changing for that cost, but it's not because of a change in price per unit. And in multi-product companies, the mix of products sold remains constant. Okay. All right, so this is our example that we're going to stick with for a little while. The contribution income statement. So we have different income statements. We talked a little bit about that in the first class. The way that they're laid out is a little different. So in a traditional income statement, you would see all of your sales, all of your costs, your gross profit, then your operating expenses, and then your net operating income. So for the contribution income statement, it's getting to that contribution margin. So it's the sales less the variable expenses. That's what gives you your contribution margin. And then you're going to deduct your fixed expenses. So it's just laying things out a little bit different, looking at the numbers a little bit different. A lot of times this is done internally for management to make decisions. So it says it's helpful for managers in judging the impact on profits of changes and selling price, cost, or volume. So try to make decisions on how to bring in the most money for the company. And so they may change some things just to kind of tweak it and see, you know, what's best for the organization as a whole. Okay, so, oops, sorry. Contribution margin is the amount remaining from sales revenue after the variable expenses have been deducted. So remember that formula. Contribution margin is the sales less the variable expenses. Okay, contribution margin is used first to cover the fixed expenses. So remember those fixed costs, we have to pay them. Let's say we have a plant. We have to have that plant in order to produce a product. So all of those costs, that rent, the utilities, all those things that are going into this building, insurance, all of that is going to be fixed for the period. And it's needed. It's not going to go anywhere, right? So we have to cover those expenses. And then we get into making money after we cover that. So the contribution margin has to cover the fixed, and then whatever is on top of that will be our profit. So this is the layout. Our example is, we have sales 500 bicycles. And I don't know, I might get into this the next slide. We're going to talk about it on the next slide. So we have sales of 500 bicycles, less the variable expenses of 150, and our contribution margin is 100,000. So we have less fixed expenses, 80,000. So our net operating income is 20,000. So anything over that fixed, whatever that fixed expense is, anything over that up to the contribution margin is the profit. Okay, so we can figure this out per unit because they told us what the total was and they gave us the quantity. So we know that we have 500 bicycles and the total sales number is 250. So how do we figure that out? We'll just do 250,000 divided by the quantity and we get a per unit. So we have $500 per unit is what we're selling this product for, this bicycle. The variable expenses, we would do the same thing. 150,000 divided by 500 is where the 300 is coming from. So it's $300. That's our variable expense. So when we take the 500 less the 300, we come up with 200. So 200 is our contribution margin. Okay, $200 per unit. So we may use that in the future. So you might, depends on how the question asks, you may be looking at totals, you may be looking at per units. So you'll have to know how to calculate that out. So if you're just given some numbers, just divide that by the quantity to come up with the per unit. Okay. Okay, so each month they must generate at least 80,000 in total contribution margin to break even. So anything over that is our profit. We just saw that on the last screen. So if we had 100,000 in fixed costs, we would have a zero profit. So we would be at our break even. So we would know that, selling the 500 units at $500 and having that variable expense of 300, if the fixed expense was 100, we would know, okay, that's my break even point. So in this example right now, we're showing a profit of 20,000. I think I forgot to turn my cell phone down. Okay. If they sell 400 units in a month, they will be operating at the break-even point. So we need to figure out if the fixed cost is 80,000, what is going to be the break-even point? So in this example, if it was 400 bicycles, you would take the 400 times the 500 each, you would get 200,000. So now it's covering just our fixed expense. So the zero profit means we're at a break-even point. So does that make sense so far? Like how you look at it and you can tell, okay, if I'm selling at a certain amount, here's my fix, I come to a zero, that's the break-even point. And we'll go into it a little bit more later, but I make sure y'all understand. Okay, so now we sell 401 bikes. So remember, it's 200 contribution margin per bike, right? Because that's what it is, 500 less the 300 gives us 200 in a contribution margin. So we're selling that one bike over. So we're gonna have that increase in operating income of $200. So now we're not at a break even, we sold one more, so you see that $200. So this is just showing you how you lay it out and how the $200 here, that one increase is going to just be the one per unit contribution margin. So now we can add more and then you make more and more and more. Yep. Okay. So if they sell 430 bikes, its net operating income will be 6,000. So this slide's just saying we don't have to lay it all out in a format of an income statement. We can calculate this without that because we know that 200 is the contribution margin. So all we have to do is take that 200 and multiply it by the units. So we're selling 30 over what our break point was. So we take the 30 times 200 and that gives us the $6,000. Does it make sense? So we had the one unit, which is 200. So if we just add one unit, you see the 200 in profit. So now you know, okay, every unit it's 200. Nothing's changing, fixed staying the same. It's the same variable cost. The contribution margin is not changing for each unit. So we can do it that way, as long as everything's the same. Okay, so here's the contribution margin income statement. It's just saying that it's got profits, which equals your sales minus your variable expense, or it could say contribution margin, because that's what sales minus variable expense is, minus your fixed expenses. So it's just kind of duplicating what we saw on the other slides. Okay, so here's the number. So if we want to plug it in, whoops, very sensitive. Did I go back far enough? Nope. Okay. So we have 401 units. Oh, I'm not sure what's happening here. Did y'all see that move? I don't even think I touched it. Oh, it's too far away. It keeps pulling out. Okay. So we have our sales, 401 units, which is times 500. It must just be one of those ones that have, you know how it does the slide in? Doesn't give me enough time here. Is there a way to pause it? I might have hit something to make it do this. No, that's not what I wanted to do. Let's see if it stays. So you have 401 units times 500. I had to do something. Maybe I can exit out of it. Okay. Okay, they are separate slides. So I might have it on like present view or something where it just keeps rolling. I don't know. All right, so we have 401 units times 500, which is the 200,005. We have the variable expense 300 times the 401 units. So we have 120,300. That right there is our contribution margin, less the fixed expenses. So we have $200. So it's just showing you in a formula format instead of doing the income statement. Basically the same calculation. Okay, let me try to go back. Let's see here, see like this. Okay. So here we go again, profit equals sales minus variable expense minus fixed expense. So we have our quantity times the selling price equals Q times P. So again, we're just doing the same exact thing, just showing you a little bit different. We have the quantity sold, Q times the variable expense. That's our variable expense. So we take the P times the Q minus the V times the Q. And again, it's the contribution margin minus the fixed expense. So they're telling you different ways. So when you have your homework, depending on how they give you the numbers, you may need it to look a little different. So maybe these slides will help if you need a reference back to them when you're doing the homework problem. Okay, so then we have the numbers plugged in. So we have the 500 times the 401 minus 300 times the 401 minus 80. This is another recap. So what we just did. P times Q, that's just that price that we're selling times the quantity, minus the variable expense times the quantity, that's the contribution margin. So at the bottom, it says here's your unit contribution margin, minus the fixed expenses. Okay, and there's the calculation again. Okay, so now we're going to look at something that has different units. So they have a different chart here, and we have 200 units, 400 units, and 600 units. So starting with 0 units, you don't have anything, right, except your fixed expenses. So you have to pay that out regardless if you have any sales. So now we're selling 200 units. So we do the 200 times the 500 per unit, because we're still sticking with that same example, $500. So we have sales of 100,000. We do the same thing for our variable expense, which was 300 times 200 units. So we have 60,000. The difference is a contribution margin of 40,000. Now we don't have enough to cover the fixed costs, right? So we have 80,000, so we're gonna have a loss of 40,000. So at least we have a little bit of something that covered some of those fixed expenses. 400 is our break point. We saw that earlier. And if we do 600 units, do the same calculation, 600 times 500, it's 300,000. Your 300 times 600, so 180,000. Contribution margin, take the difference, 120. Subtract your fixed expenses of 80, so we get a $40,000 profit. Okay, we're just looking at the different quantities and how it changes. Okay, I am skipping through the graphs. Okay, so we have the contribution margin ratio. So the ratio is going to be a percentage. Okay, so here's our formula. So we're going to have the contribution margin, which is that dollar amount, that $200, and we're going to divide it by the sales. That's the contribution margin ratio. All right, so the contribution margin ratio is calculated as follows. Well, that doesn't, let me see. The 80,000 was our fixed costs. I'm not sure where else that 80,000 is coming from, unless we're doing another example. I don't know. Hang on, let me go back. So we had fixed costs of 80,000. I don't know. It should be the contribution margin over the sales. So we must be doing a different example. We might be doing the 400 units. When it 400 units, it gave us, is our contribution margin 80,000, it covered our fixed costs? It's gotta be. So yeah, because 200,000 in sales would be the 400 units times 500. Okay, sorry, I was confused. I was thinking we were going with the 500 units. Okay, so we're going with the break even. So it's 400 units for this example here. So we have the contribution margin, which is the 80,000 total. The 200 per, so it's 200 times 400, 80,000. And then we have the sales, which was 500 times the 400. So that's 200,000. So when you divide them, you get 40%. Okay, so the contribution margin ratio is 40%. So you may only have the contribution margin ratio in the example. So they may give you some information, you have to use the ratio, or it may just give you the ratio in the example. So for each dollar increase in sales will result in a contribution margin increase of 40 cents. So 40 cents. Okay, does that make sense? All right, contribution margin can also be calculated by dividing the contribution margin per unit by the selling per unit. So now we're going to do 200, which is the contribution margin, divided by the $500, which is the sales per unit. Still get 40%. Okay, so now we have our variable expense ratio. Again, it's going to be a formula. So we're looking for the variable expense over the sales. So it'll be the 300 times the 400 units. We get 120,000. And then we have the 500 times the 400, which is the sales. That gives us a total of 200,000. So the 120 divided by the 200 is 60%. I don't know if I'm going to go over that. Okay, so here's the breakdown again of our 400 units and our 500 units. So we're just saying that an increase of 50,000 in sales results in a 20,000 increase in the contribution margin. I mean, it's not the contribution margin, it's the profit, the net operating income. Okay. So if you have a question that says, okay, well, how much if you produce this instead of this, then you would just calculate same thing, see what your increase is. Okay, so we have coffee. Klatch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49. The average variable expense per cup is 0.36 cents. The average fixed expense per month is $1,300. So an average of 2,100 cups are sold each month. What is the contribution margin ratio for Coffee Klatch? Okay, so we're looking for that percentage. So remember, we want to do the contribution margin divided by the sales. So we're going to look at $1.49, which is our sale, minus the variable expense, 0.36. That gives us our contribution margin of $1.13. Okay, so we take the $1.13 and then we're going to divide it by the sale per unit, which is the $1.49. So we get 0.758. Nope. Well, there you go. All right, so here's your little formula: unit contribution margin divided by unit selling price. So we're just taking the 149 minus 36, get your contribution margin per unit, and then divide by per unit. So they gave us 2,100 cups are sold each month, but they weren't looking for us to do anything with that. They just wanted to know the ratio. Okay, so now we have our contribution margin ratio times the sales minus the fixed expense. So that's going to be the relationship between that sales and trying to figure out the profit. Okay, so we increased the sales volume to 500 bikes. What would management expect profit or net operating income to be? So if we have the contribution margin ratio, we can take the 40% and multiply it by the 250. Now we're back to 500 units again. So we have the 500 units times the $500. That gives us our 250 in sales. So we're going to say 40% is the contribution margin times the 250 to come up with 100,000. And then we have to subtract the 80,000 fixed expense out of it. So we're back to our profit of 20,000. Okay. So what is the profit impact if RBC can increase unit sales from 500 to 540 by increasing the monthly advertising budget by 10,000? So we have two things that happen here. So we're going 40 units up from the 500 because we have 540 now. We're also going to increase that monthly advertising budget of 10,000. So where do you think the 10,000 is going to go? As part of what? Of variable or fixed? Fixed. We're going to add it to the fixed. So now our fixed, instead of being 80, we're increasing it by 10, so it's going to be 90. So we have, can y'all see when I write on it? So we have the 540, yeah. Units times $500. So now our sales are 270. And we have our variable expense. It's the 540 units times the 300. So we have 108 contribution margin. And now our fixed are 90. So we have 18,000. So even though we increased our quantity, we also increased our advertising to increase that quantity, but did it help us out? Not really, because our profit went down a little bit. So I guess you would hope that if you're going to spend that extra money in advertising, you can get a little bit more in profit. So not always when you do the calculation. So these are some of the things that management may do on a larger scale, but these are some of the things that they would look at and make decisions Okay, is it worth spending that money on the advertising? Maybe there's something else they can do. Okay, so we have our sales increased by 20,000. Now it could be beneficial. Some manufacturers that when you sell their products, if you hit certain quantity levels, you'll get bonuses. And so you'll get like money outside of this. So depending on what it is that you're producing. So, and what you have, like they're selling bikes. And so sometimes those manufacturers that are producing those bikes, you're selling the bike. So it may be that, you know, you're able to get a little more money at those retailers. And then you can get a little kickback from whoever you're using for your parts or whoever that manufacturer may be. So you can look at it from a production standpoint, or you can look at it from a retailer standpoint. Sometimes they'll have some kickbacks. So I know like in the AV industry, like with these projectors, like if you had certain quantities, you got different cost discounts. Sometimes you got a rebate on a particular brand if you sold so many. The car dealership industry is the same way. So these car dealerships that are bringing in the cars, when they have these new units, they sell so many, they could be hitting other levels. So they could bring some money in other ways. So with a production team, it may be that there's a certain product that goes into the units that maybe you get some kind of rebate or something on. Okay, so if you don't want to list out onto that income statement, you don't have to, you can just do the quick way. So we increased the sales by 40. So we can take the 40 times the contribution margin instead of calculating out, okay, I had 540 units, multiplying it by the sales number, 540 units, multiplying it by the variable expense. I can just go straight to the contribution margin that I know is 200 and just multiply it by the increase, which is the 40,000. And then I add my increase that I'm going to have for the fixed cost, which is 10,000. And I can see it's going to decrease my operating income by $2,000. Okay, so you don't have to do the long route that we just did. You could do it like this. If you understand it enough, you can pull out just the quantity of increase and multiply the contribution margin, and then just look at it in comparison to what the increase is when you fix. Okay, so example number 2. What is the profit impact if RBC can use higher quality raw materials, thus increasing variable costs per unit by $10 to generate an increase in unit from 500 to 580? Okay, so now we're gonna increase by 80, but our contribution margin goes down. Oh, it's right here. Our contribution margin goes down. So remember, our contribution margin was 200. So now it's gonna be 190. Okay, but let's look at it broken out the long way first. Okay, so we have our 580 units. What's changing is the units, the sales price is staying the same. So our sales revenue number is changing, but it's only because of the quantity. So we have 80 more units. So we have 580 times the 500 to get the 290. And then we have variable expenses that are changing. So remember they were 300. Now it's going to be 310. So we're taking 580 times the 310 to get the 179.80. So this changed because not only just quantity, but also because the cost changed. All right, so now our contribution margin is 110, 200. Fixed expenses, 80,000. And now we have a net operating income of 30,200. So you see how the profit changes. So it's telling us we increased, you can look at the difference between your sales, 250 to 290. So we increased the revenue by 40,000. And then we have a net operating income increase of 10,200 by making that change. So because we used a little better part, more people want to buy the bike. Okay, so what is the profit impact if RBC cuts its selling price $20 per unit? So remember, we were at 500, so this will put us at 480. Increases the advertising budget by 15,000 per month. So we're looking at fixed going from 80 to 95. And then we have increased sales from 500 to 650. So we have 150 units in sales more. All right, so we're going to look at it the long way. All right, so we have our 650 units, multiplying it now by the 480, because remember we reduced our price. So since we reduced our price, we were able to increase our quantity. So now we have revenue of 312,000. The variable expense stays the same. We didn't do any changes there. So that's just the 650 times the 300 to get the 195. So we have a contribution margin of 117. So remember, we added 15,000 to our advertising, so our fixed costs are higher. So now the income is $2,000 more. So we made that change. We sold a lot more units, but we only increased revenue by $2,000. So we increased the sales 62,000. We have fixed cost increase of 15,000, and our net operating income increased by 2,000. We made a lot of changes to make $2,000 more. Okay, another example. So what is the profit impact of RBC if they pay $15 sales commission per bike sold instead of paying salesperson's flat salaries of $6,000? So what's happening there? So now it's saying 15 per bike. So that's going to be our variable now. So because we're going to have to use it with our quantity, it's not going to be a flat cost. But the 6,000 was our flat cost. So that's also going to change our fixed assets. I mean, our fixed expenses. So we have to reduce the fixed expenses. We're going to reduce that down by 6,000. So we have two changes. One is the variable expenses going up, and one is the fixed costs going down. And then we increase our unit sales from 500 to 575. So again, we're changing our quantity. So now we're going to calculate it out. So here's our 575. The 287 right here is our 575 times 500. And then our variable, we have to remember that that changed. So now we have the 575 times 315, because we include now $15 commission for the product. So we have 575 times 315, it gives you 181. Contribution margin of 106,375, and we adjust fixed down 6,000 because now we're not going to have that flat 6,000 payment. We're using it. We're only going to pay if they sell. Before we were just paying it regardless of how many units we sold it. Okay, so net operating income now is 32,375. So we increase our sales by the 37.5. We decrease the fixed expenses by 6,000, and the net operating increase is 12,375. So you see how just changing different things changes your profit. Just don't get confused on where it needs to go. That's the main thing. Okay, so RBC has an opportunity to sell 150 bikes to a wholesaler who's distributing sales to other customers or fixed expenses. What price would it quote to the wholesaler if it wants to increase monthly profits by $300? No, $3,000. So we have an opportunity to sell $150,000 bike, 150 bikes. I can't talk tonight. 150 bikes to a wholesaler without distributing sales to other customers or fixed expenses. So what does that look like? Okay, so we're going to take that 3,000, divide it by the quantity, which is 150. So we get $20 per bike. So the variable per bike is 300. That stayed the same. So now we have a selling price that's required of
Welcome to Bixby. You can talk.
Sorry. Selling price required is $320. I know I'm all over the place tonight. It's not good. It's my ADD maybe. Selling price required is $320 per bike. Okay, so now we have to cover, if they want that $20, the 150 bike sale, we have to cover that by adding it to the sales number. Okay, so we have 320. So if we have 150 bikes times 320 per bike, that'd be 48,000. Total variable cost is 45,000, which is the 300 times the 150. So we increase our net operating income by $3,000. Okay. All right, so we talked a little bit about the break-even point earlier, that break-even analysis. So there's different ways you can look at it. You can look at it from units and you can look at it from dollars. So we're going to go through that. But it's where you get to a zero profit. That's your break-even point. All right, so we have two ways. We have the equation or the formula. So we have the profit equals unit contribution margin times the quantity minus fixed expenses. So profit would be zero because we're looking for that break-even point. We have 200 in contribution margin times the quantity minus the fixed expenses. Okay, so we're just going to move the formula around to solve it. Okay, so we have 200 times Q equals the 0 plus the 80. So we're just moving that number over, separating out the 200 Q. And then we have the 80,000 divided by the 200 because we're trying to get the Q by itself. Just solving algebraically. Do y'all see that? Okay. So we have a quantity of 400 units. So we're just saying, okay, we have 80,000 in fixed expenses and we have 200. That's our contribution margin. So this is how you're calculating how many units to get to that zero. It's 400. So we had looked at that earlier on the chart, but this is how you would solve it if you didn't have that chart. Okay, or we can do this. Unit sales to break even. So how many units do we have to sell? We take our fixed expenses divided by the unit contribution margin. So our fixed expenses were 80,000 and we're dividing it by the contribution margin of 200. And that would give you 400 units. Okay, suppose RBC wants to compute the sales dollars required to break even. So we're going to use the equation method and the formula method to solve. So we'll do it both ways. Okay, so there's that contribution margin ratio. So if they don't give you the ratio, you have to remember what the formula is to solve that. So you have your profit equals the contribution margin ratio times the sales minus fixed expenses. So remember the profit 0. We have 40% times the sales minus the 80,000. Okay, so now we're going to do the same thing. We'll just bring the 0 to one side, bring the 40% S to the other side. So we do 80,000 divided by 40%. So now I know my sales to break even. So I need 400 units and I need sales of 200,000 to break even. So you're basically doing the same thing, just looking at it, coming at it from a different direction. Okay, so now let's use the formula method to calculate the dollar sales at the break point. So now we have dollar sales to break point, and we're going to do fixed expenses over the contribution margin ratio. So you have dollar sales equals 80,000 over the 40%. So we end up with the same thing. So the dollar sales equals 200,000. So whichever way is easier. And the homework, they may ask you different ways. I'm not sure how I pulled that, but anyway, so you have different ways you can do it. Everybody has a different method that works better for them. Okay, Coffee Clutch is an espresso stand in a downtown office building. The average selling price per coffee is $1.49. The average variable expense per cup is 36 cents. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. What is the break-even sales dollars? So we need to know how much we need to sell a break-even. So remember the fixed expenses is 1,300, and we can divide that by that contribution margin ratio. So we did the contribution margin ratio earlier. We did the 149 minus the 36 cents, give me the 113. And we divide that by the ratio. I mean, we divide that by the 149, and that gave us that ratio of 0.075. Remember when we did that earlier on this example? So that contribution margin ratio is what we're going to use in the denominator. So we have fixed costs of 1,300. And we're going to divide it by that contribution margin ratio, which was at 0.75, and I'm gonna cheat because I gotta see what the last, it was 758. So when you do the math, you get 1715. So same example from earlier when we were doing the contribution margin ratio. Okay, the average selling price of coffee is $1.49. The average variable expense is 36 cents. Average fixed expense is 1,300. Average of 2,100 cups are sold each month. What is the break even in sales in units? So we want to know the unit, like how many cups is it? So we're going to do the fixed expenses again over that contribution margin per unit. So remember, it's this $1.49 minus the 36 cents. So we do the math. So it's D. So let me see. We're using, so they have the equation one that's written out, and then they have the formula one, which I guess I've been doing the formula one. So the unit sales to break even on the formula is fixed expenses divided by unit contribution margin. And that's what we just calculated. Okay, target profit analysis. So target profit, what do you think that is? Yeah, so we're trying to hit a target. What kind of profits do we want to make? So that's what we're going to be looking at next. So in target profit analysis, we estimate what the sales volume is needed to achieve a specific target profit. So we can compute the number of units that must be sold to attain a target profit using the equation method or the formula method. So same thing we've been doing. We can use either way. All right, so for target profit analysis, we have the profit equals unit contribution margin times the quantity minus the fixed expenses. So instead of the profit being 0, now we have a goal in mind of what we want to make. And so that's what would go there. So we're doing the same thing, but instead of having 0, now we got to have a number of money that we want to make. Okay, suppose RBC's management wants to know how many bikes must be sold to earn a target profit of 100,000. So now the profit is 100,000 equals the contribution margin of 200 times the quantity minus 80,000. So now we do algebraically, we solve it. So we come up with the 100 plus the 80,000. So now we're not only covering fixed expenses, but we need to cover the profit that we want to make on top of that. So does that make sense while we're adding those together, right? So we're not only covering fixed, we want another 100,000. So now we need to cover that. So we can find out what our target units are. So we have 900 units that we need to sell to hit that target of 100,000. Okay, same formula, you just plug it in. All right, the formula method. So we have the unit sales to attain the target profit plus the fixed expenses over the contribution margin per unit. So we have to figure out, let's see, we're doing the same thing with the 100,000. So we know we need to cover the 100,000, that's our target profit, plus we need to cover the 80,000. And so we have 180,000 divided by the contribution margin unit, 200. So we get 900 units. I personally like this better, the formula. Find it a little bit easier. Okay, we can also compute the target profit in terms of sales dollars. So now we're doing the same thing we did with the break even. So we looked at units and then we looked at sales. So we're doing the same thing with the target. So we're going to look at units. You can figure out how many units you have to sell, and then we can look at how much do we have to sell in order to make that profit. Okay, so now we still have that 100,000. So we're going to do the 100,000, and then that equals the contribution margin ratio times the sales minus the fixed expenses. So we got that 40% S, it sticks together. So we're gonna move things around, 100 plus the 80. That gives me my 180,000. And then I'm gonna divide by the 40%. So my sales are gonna be 450,000. That's what I have to sell. And again, I think this one's easier. So we have our target profit, 100 plus that 80,000. The contribution margin ratio is 40%. So our dollars are 450,000. So if they're looking for unit, you're going to use the contribution margin. If you're looking for sales, you're going to be using the contribution margin ratio. Okay, so we're back to the coffee shop. So it's the same numbers, $1.49 to sell, 36 cents is our variable. The average fixed expense per month is $1,300. So we're going to use the formula method to determine how many cups of coffee would have to be sold to attain a target profit of $2,500 per month. So we're going to do the formula, which is easy. So we're going to do our target, which is $2,500, plus our fixed is $1,300, divided by our contribution margin, per unit. So it's the $1.13. The 149 minus the 36. So when you do the math, it's 33.63. Y'all have any questions so far? Y'all okay with this? Getting it? Okay. Okay, so now they want to know, using the formula method to determine the sales dollars that must be generated to attain the target profit of $2,500 per month. So we're doing the same thing at the top. We're doing the $2,500 plus the fixed costs. And then we have to use that contribution margin ratio, which was 0.758. So remember, that's just that contribution margin divided by the sales price. So it's the 113 divided by 149. That's where that 0.758 came from. So when you do the math on that, you get 5,013. So they break it down on the slides for you, so you can figure out if you get confused on homework. You want to go back to these. Okay, so now we have the margin of safety in dollars. Margin of safety is the excess of budgeted or actual sales dollars over the break point, the break-even volume of sales dollars. It is the amount of which sales can drop before losses are incurred. So we're looking to see how can we avoid those losses, right? So we can do that margin of safety. The higher the margin of safety, the lower the risk of not breaking even and incurring a loss. All right, so we have the margin of safety in dollars equals, so we have total sales minus break-even sales. Total sales minus break-even sales. Okay, so we're going to assume RBC has actual sales of 250,000. Given that we already determined the break-even sales will be 200,000, the margin of safety is 50,000 as shown below. So we know that it's 400 units in order to break even. And we're just looking at the difference between the sales. So it goes from 250 to 200 for our break even. So that margin of safety before we start incurring a loss is 50,000 in sales. Does that make sense? Anything, if we start selling anything less than that, then, or under that 250, we're going to have a loss. RBC's margin of safety can be expressed as 20% of sales. So we have that 50,000, which is the difference between the break even and the 500 units that we're selling. That 50,000, and then you divide it by the sales, the actual sales, which is the 250,000. So that's how we get the 20%. Okay, so then it says we can express it in terms of the units sold. So the margin of safety is 50,000. If each bike sells for $500, RBC's margin of safety is 100 units. So that's the difference between that, what we're selling in actual, what that break-even point was, which was 400 units. So we take the 50,000 divided by the 500 to come up with 100 bikes. Okay, back to the coffee shop. So all the numbers are the same. We have an average of 2,100 cups are sold each month. What is the margin of safety expressed in cups? So we want to know how many cups. So we do our total sales minus the break even. All right, so our total cups that are sold, 2,100 minus the break even of 1,150. I don't remember if we figured that out. 950 cups. Did we do the example with the break even? Maybe we did. Let me exit out of this and see. I just want to make sure it's there. I think it is. I'm gonna discard it. Maybe we didn't. This is all the break even. Break even sales. Oh yeah, we did. Here it is. Okay, good. I wanted to make sure it was there. Okay. Give them a second. Okay, there we go. All right, so remember the formula for the margin of safety. Okay, total sales minus the break-even sales. Okay, so we have cost structure and profit stability. So high and low fixed cost structures. So last semester, I didn't talk about this. I just kind of skipped it. But it was one of the questions on the 10 questions that they wanted me to put on the last test. So I guess I have to go over it. Because they're going to ask you a question about that. And I'll give you an example. I may not ask this on the test. We're just going to go over it. But I'll give an example in the final review before that test so you know how to do all the problems that they're going to be asking you. Okay, so there's advantages and disadvantages to the high fixed cost or low variable cost. And low fixed cost or high variable cost structure. So an advantage of the high fixed cost structure is that the income will be higher in good years compared to companies with lower proportion of fixed costs. Disadvantage of high cost structure is that the income will be lower in bad years compared to companies with lower proportion of fixed costs. So we have companies with low fixed cost structures. They enjoy stability and income across good and bad years. So if we have that low fixed cost, then you don't have to cover as much. So when you have those bad years, obviously it's not going to be so bad for you. But if you have a lot of high fixed costs, obviously you're going to be struggling in a bad year because it's going to require even more, right? Because you're having to cover all those high costs. So I guess you could live your life like this too if you have a lot of debt. It'd be really bad in those years if you have a downturn in the economy and you lose your job, right? And you got all these high costs. Wouldn't be good. So just my little advice is try to live within your means. Don't spend too much all at once. Don't do too much credit cards. Try to pay cash. Let me see if there's some other stuff that I wanted to go over. Okay, so we're going to do degree of operating leverage. I do want to cover this. Okay, so we have operating leverage, which is a measure of how sensitive net operating income is to percentage changes in sales. It's a measure at any given level of sales of how a percentage change in sales volume will affect the profits. So some companies, if they're evaluating an organization, they may use this formula. Okay, so we have our degree of operating leverage equals the contribution margin over the net operating income. Okay, so we're going back to our example that we had earlier. So we have 500 bikes. So we're looking for our contribution margin, which was 100,000, and we're looking for our net income. That's the 20,000. Okay, so remember the formula, contribution margin over net operating income, or NOI. A lot of times we just reference it as that, so I have to say the whole thing. So 100,000 divided by 20,000, so our degree of operating leverage is a 5. Okay. With an operating leverage of 5, if RBC increases its sales by 10%, net operating income would increase by 50%. So we have a percent in sales increase 10%. So we would multiply it by that 5, that degree of operating leverage, and that gives us 50% increase. So it tells us how it's going to affect our profit. All right, now we're going to show you the proof. Okay, so if we increase to 550, we calculate all the numbers. So we have 10% increase in sales from 250 to 275 results in a 50% increase in income from 20,000 to 30,000. Okay, so we found the degree of operating leverage is a 5, and then we can calculate what we think it's going to be. If we want to increase sales by a certain amount, we would know how much profit that we're going to gain. Okay, so we're back to the coffee shop. So they want to know, what is the operating leverage? Oops. We already saw the answer. I was going to write it out. I forgot to put my little pen. Okay, so we have the actual cups of the 2,100. So we're going to have sales of 3,129. Variable expense is 756. So we come up with our contribution margin, which is 2,373. And then our operating income is 1,073 because we have that fixed expense of 1,300. So we're just dividing the 2,373 divided by the 1,073, which gives us the $2.21. So that one, they didn't tell us the total sales. We had to calculate that out. They just gave us the units. So just remember, if they do that, just calculate that out, and that contribution margin is your sales less your variable expense. I think that was one of the questions on the test too. Did I ask you about the contribution margin? I think I did. A coffee clutch, the average selling price of a cup of coffee is $1.49. 36 cents is your variable, 1,300 fixed. We sell in 2,100 cups. So if sales increase by 20%, how much should net operating income increase? So we have a 2.21 degree of operating leverage. So what's our percent? Oh, dang. Our percent, I'm not doing this right. 20%. The degree was 2.21. So if we do the math, it's 44.2%. See, that's how much we can expect the revenue to go up. I mean, the operating income. All right, so here's the chart. They're showing you your actual here, what the increase in sales would be. So they're just taking that 3129 and increasing it by the 20%. And then you find out your quantity, do all your numbers, calculations, and you'll see that your income, your net operating income increased that 44%. Okay, so normally for the sales team, you'll get paid either a commission or you'll get a salary plus commission. So if you're on commission only, usually you get a higher percentage. If you're getting a base salary plus commissions, you usually have a lower percentage on the sales because you're getting a base. So commissions based on sales dollars can lead to lower profits in the company. So we're going to look at an example. So we have Pipeline Unlimited produces two types of surfboards, an XR7 and the Turbo. The XR7 sells for $100 and generates a contribution margin of $25. The Turbo sells for $150 and earns a contribution margin per unit of $18. The sales force at Pipeline Unlimited is compensated based on sales commissions. I don't know why it keeps beeping like that. Okay, so if you were on the sales force for Pipeline, you would push hard to sell Turbo, even though the XR7 earns higher contribution margin per unit. So to eliminate the conflict, commissions can be based on contribution margin rather than the selling price alone. So a lot of times too, you won't get paid commission on the sales price. So if you get paid commission on the sales price, your sales commission will be a low amount. If you get paid commission on the profit, your commission's a little bit higher. So sometimes you would get paid. It's like at the car dealership, I did sell cars for a little while and it was like 25% of the profit, like whatever we made on the car. So if I didn't sell, I didn't make any money. But sometimes when I worked at the AV company, we had different structures. So somebody coming in that's new, that needs to, develop their territory, has to get their clientele built up, we would give them a base. And sometimes it was a large base at first, and then they had a small commission. And then as you go and you build your territory, or you gain your clientele, your base could go down and your commission goes up. So if you have a base, you could have a lower commission. If you have just commission, you usually higher. If it's on a sales number, it's going to be lower, because think about it, your sales are higher than your profits are, right? So if they have that high number on the profits, then that's really good for you. I mean, on the sales, it'll be really good for you. So if y'all wind up in some kind of sales position, there's lots of different structures. So just figure out like reasonable, like what do you think profit is? So you could find out if you're going to be selling a particular product, you could say, okay, well, how much do we make per product? Like what is the profit on that? So then you can you can be reasonable when you're figuring your calculations on, they say, okay, we're going to pay you 25%. Well, what's a reasonable profit? So then you can calculate that. Okay, let's go down. I'm not sure I want to cover, won't move. There it goes. So we have the sales mix. I don't remember if I have anything on homework. I don't think I do on the sales mix. That's just showing you that you can have different products and you have different variable expense on each one of those products, and you're looking at it, each one, and then you total it. But I don't think that I actually show anything with homework on that. I definitely won't be asking that on the test. So we are done with chapter 5. So we're only doing chapter 5 and chapter 6, and then we're having a test. Okay, so it's a little bit different information, and I feel like it's a lot of different ways to look at things. So go through the homework, see if you have any questions for next week on that, and we'll cover chapter 6 next week, and then I'll have a review up for the next test.